What if I told you that one single investment, available to anyone, with as little as $1, has outperformed most professional fund managers over the last 30 years? No stock picking, no market timing, no finance degree required. That investment is called an ETF. And by the end of this video, you're going to know exactly what it is, how it works, and which one you actually need to start building real long-term wealth. Let's start with the basics. ETF stands for Exchange Traded Fund. But forget the acronym for a second. Here's the simplest way to understand it. Imagine you walk into a grocery store and instead of buying one apple, you buy a basket that contains 500 different fruits. That basket is your ETF. When you buy one share of an ETF, you're not betting on one company. You're investing in hundreds of them, all at once. If one company in the basket fails, the others carry you. Your risk is spread. Your portfolio is protected. This is called diversification, and it is one of the most powerful principles in investing. Now you might be wondering, how is an ETF different from a mutual fund or just buying a regular stock? Great question. A stock is one company, high potential reward, but high risk. If that company fails, you lose everything invested in it. A mutual fund is also a basket of investments, but it's actively managed by a professional. That professional charges you a fee, typically 1 to 2% per year, and most of the time, they still don't beat the market. An ETF is a basket of investments like a mutual fund, but it's not actively managed. It simply tracks an index. Lower fees mean more money stays in your pocket, and over 30 years, that difference is worth tens of thousands of dollars. So which ETF do you actually need? I'm going to give you one name, and I want you to remember it. VOO, the Vanguard S&P 500 ETF. This single ETF tracks the 500 largest companies in the United States. We're talking Apple, Microsoft, Amazon, Google, Nvidia, Berkshire Hathaway, Johnson & Johnson, and 493 more. When you buy VOO, you own a tiny piece of all of them. Now here's what makes VOO exceptional. The expense ratio, the annual fee you pay, is just 0.03%. That's $3 per year on a $10,000 investment. Compare that to a mutual fund charging 1.5%. That's $150 per year on the same investment. Multiply that over 30 years, and the difference is staggering. Low fees, maximum diversification, proven 30-year track record. VOO is where I would start. And for most people, it's all they will ever need. Let's see what VOO and the S&P 500 it tracks has actually done over time. Over the last 10 years, average annual return, approximately 13%. Over the last 30 years, average annual return, approximately 10%. Now, past performance does not guarantee future results. But here is what history tells us. Every single time the market has crashed, 2000, 2008, 2020, it has recovered and gone on to reach new all-time highs. The stock market rewards patience, not timing, not genius, just patience. So how do you actually buy VOO? Step 1. Open a brokerage account if you haven't already. Fidelity, Charles Schwab, or Vanguard directly, all free, all beginner-friendly. Step 2. Fund your account. Transfer any amount, even $10, using fractional shares. Step 3. Search for the ticker symbol VOO, click Buy. Enter your amount, confirm. Step 4. Set up automatic monthly contributions, even $50 a month, even $100, whatever you can consistently afford. And then, the hardest part, leave it alone. Don't check it every day. Don't panic when it drops. Don't sell when everyone else is scared. The people who get rich from index funds are the people who forget they own them. Now, a quick word on two other popular ETFs you've probably heard about. SPY, the SPDR S&P 500 ETF, does exactly the same thing as VOO. Tracks the S&P 500. The main difference, SPY has a slightly higher expense ratio at 0.09%. VOO is cheaper. For long-term investing, choose VOO. QQQ, the Invesco Nasdaq 100 ETF, tracks the 100 largest tech companies. Apple, Microsoft, Nvidia, Meta, Tesla. Higher potential returns, but also higher volatility. For a beginner, start with VOO. Once you're comfortable, you can add QQQ for extra growth exposure. Let's bring it all together. An ETF is a basket of stocks that gives you instant diversification at a fraction of the cost of a mutual fund. The one ETF you need to start, VOO, Vanguard S&P 500 ETF. Expense ratio 0.03%. 500 companies. One investment. Buy it, automate it, leave it alone, and let compound interest do the rest. You don't need to be a financial genius to build long-term wealth. You just need to start and stay consistent. That's the entire strategy. If this video helped you, subscribe to Wise Money Lab. New videos every Tuesday and Friday. Next video, we're talking about the power of compound interest and how $200 a month can turn into over $1,000. You do not want to miss that one. Wise Money Lab, financial education for today's reality. I'll see you Tuesday.